All right, perfect. Looking to close this particular chapter and get a good understanding about the last topic that is left in this chapter. And that last topic that we're looking is capital rationing, one of the more simpler topics. So let's look into the sum and get a good understanding about the concept. From there, we will look into the theory of this topic. First, we'll finish. Okay. Starting off here with our TYU 6. What about our TYU 6? Let's look into this here. This particular question of TYU 6 says that Peel Co. has identified 4 positive NPV projects as follows. So we have the 4 projects here as follows. So we're looking into this. Number 1, Project A, Project B, Project C, Project D. They have 4 projects. Okay. And they can only raise 12 million. Okay. Each project, if you do all the projects, you need totally 20 to 31. Totally, you need 31 million, but they can only raise 12 million. So now they have to be smart where to invest how much money, right? To do all the 4 projects, they need 31, but they can only raise 12. So they have to be smart where to use what, right? They have to be smart where to use what, right? They have to be smart where to use what. So they can't do everything right now. So they have to be smart about what they're using. So 12 projects are there. 4 projects are there. 12 million if they have, but if you did all the 4, they needed 31, which they don't have. So they have to be smart about how they are investing. So now I advise the company which project to accept and which project to ignore. That is the question. Okay. Now we look into it. If the project is independent and divisible, we use a method called as profitability index. If the project is divisible, we use a method called as profitability index. So let's look into this here. Profitability index method. So here you find the NPV per dollar, right? So for $9, 9 million if you invest, you get 60 million. Okay, 9 million if you invest, you get 60 million. Let's quickly do this here. Shri, just do 60 divided by 9. Okay, so this is your NPV per dollar. Okay, 6.67. Okay, quickly for the same for B. Okay, for C. Yeah. Perfect. So once you've done this, once you found the profitability index, once you found the profitability index per dollar, once you've done that, then you do the ranking. You see, based on that, whichever is the highest rank product, highest rank opportunity for you. So after looking into this, you found out the first highest ranked opportunity is this, and then this is the second one, this is the third one, this is the fourth one. Now you invest. So first you should do full of project A. 9 million is gone. If you do full of project A, 9 million is gone. Now you have 3 million. So next you should do project C. For C, you need around 6 million. So you can only go for half of the project. Why can you do half of the project? Because the project is divisible. So you can go for half of the project. So you can get half of the NPV also. So 17.5 NPV will get. First project will get 60. Second project will get 17.5 NPV. So your total will be 77.5 NPV. So this is what you should do. That you should do full project A and half of project C. Because project C was the second rank and then this was the first rank. And this much when you do, your money is over. That's it. Okay. Did you make sense of this one, Yashi? What's happening? Okay. Next, we'll look into independent and indivisible. So even if it's independent and indivisible, firstly, you will do full of project A. Okay. So the project A indivisible, the trial and error method you have to use, right? You have to use the trial and error method, right? So choices of 12 million investment are either you can do only A. Okay. If you do only A, your total NPV that you're getting is 60. Either you can do only B, then your total NPV that you're getting is 40. Or if you do C plus D, your total NPV you're getting 55. But overall, the best one you can do is just do A and you'll get 60 million. Here you cannot do half of project C because the projects are indivisible. Right? Why can't you do half of project C? Because the projects are indivisible. So you cannot do half of project C. In the first case, you could have done half of project C because the projects were divisible. Here you can't do half of project C because they are indivisible. Okay? You cannot do half of project C. So that is why in the second case, you should do only A. Next, we'll look into the third one here. What is the third one telling? Where the projects are mutually exclusive. Okay. When projects are mutually, if the projects are mutually exclusive, pick the one with the highest project NPV. Just go with A, that you can only do one. You cannot do any of them together. If you want only one, you can choose. So then also in that A is the better option. Mutually exclusive means you cannot do any two together. Mutually exclusive means I cannot do any two together. Okay. 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 If they just go for mutually exclusive, what does mutually exclusive means? Mutually exclusive basically means that they go for mutually exclusive. Mutually exclusive, they cannot do any of them together. They can do only one. Either A, either B, either C, either D. In that, obviously, A is the best because it's giving you highest NPV. It's giving you highest NPV per dollar. So overall, A is the best one. So just do that. That's it. Okay. It makes sense of all the three here. Is it clear to you? Three? Is this clear? See, can you hear me? Okay, it's clear this one, right? Okay, perfect. Moving on now. Okay, so TYU6 is also complete here. We've got a strong understanding about TYU6. TYU5 we have finished in the previous session. We have discounted payback period. We'll look into it as we are looking into payback. So whenever there is a multi-period capital rationing, right? What do you mean by multi-period? You will not be expected to produce any calculation related to this. The AFM syllabus relates only to limits its coverage multi-period to discussion only. So in multi-period there is no calculation. In AFM syllabus, multi-period there is no calculation. Okay. In AFM syllabus there is no calculation here. So what does multi-period just basically means in simple words here? Multi-period just basically means here is that for more than one period, there's a shortage of capital, right? Because even in the previous sum, you needed 31 to do all of them, you had only 12. So multi-period basically means that you don't just have one budget shortage in 1 year. You basically have budget shortages for multiple years. Like multiple years, you don't have enough money to do all the projects, right? So we cannot use PI method here. PI only works when there's a 1 year shortage. 1 year there's a shortage, you can use PI, but there are multiple years when there's shortage. Using PI will get messy. So the solution is you use linear programming or mathematical techniques. What do you use? You use linear programming or mathematical techniques. That is generally used to solve these problems. Okay. So the AFM syllabus, as you know, they will not ask anything to calculate. They will just ask you to discuss. So what is multi-period? Is that first of all, you don't have shortage for just one. The shortage is not just for 1 year. Multiple years there's a shortage, right? So there's a shortage not just for 1 year. There's a shortage for multiple years. That's the first thing. The shortage is there for multiple years. And how do you solve this? You cannot use a PI method to get around this problem. You use linear programming techniques to come up with an answer, which is not part of AFM. It's only limited to discussion. Okay, so that is your multi-period rationing. Yeah, did we get this one, Sri? Okay, moving on now. The impact of corporate reporting on investment appraisal. So let's look into this. What is the impact of corporate reporting on investment appraisal? So here, if you just simplify this, the main rule is, so when we look into the impact of corporate reporting, the main point that we are looking to do is that the main approach to evaluating capital investment projects and financing options for profit maximizer is their impact on shareholder value, right? So you, no matter whatever you use, ultimately you want to know that whenever you evaluate an investment project, the ultimate thing you want to know is what is its impact on shareholder value. Sorry, what is its impact on shareholder value? The main thing you want to know is what is its impact on shareholder value. Okay, the main thing we want to know is what is its impact on shareholder value. However, the impact on the reported position and performance of the firm must also be considered. So obviously look into the shareholder value, but along with that, you also look into the impact that will be there on the financial position and performance of the company should also be considered when evaluating a project. Okay, so when you're evaluating a project, what you have to do is also look into the impact that will be on the balance sheet of the company and the P&L, right? So in particular, you may need to examine the implications for what will you examine, right? You will need to examine the implications for Firstly, you will examine the share price. You will examine for the gearing, for the ROC, and for the earnings per share. Okay, so the main approach to evaluating capital investment projects and financing options for a profit maximizer is their impact on shareholder value. So the main approach to evaluating capital investment project and financing options for a profit maximizer is basically their impact on shareholder value. Okay, is their impact on shareholder value, first thing. However, the impact on the reported financial position and performance of the firm must also be considered. You should also consider not only the impact on shareholder value, but what it's doing for the firm. Hence, you need to examine the implications for the share price, gearing, ROC, EPS. Right? You have four things to check. So what they're saying is, evaluating a capital investment project, use NPV. The goal is to increase the shareholder value, but NPV is not the only thing. You must also check how the project will affect the company's reported results. Now, exactly what? The share price of the company, how a project will affect the gearing level, how a project will affect the ROC, how the project will affect the EPS. So you just don't assess a project by what it will do to the shareholder wealth. You also assess the project based on how it will impact the financial position numbers like share price, gearing, ROC, and EPS. So that also is a metric to measure a performance. You just can't keep it on the fact that how much shareholder wealth it is increasing. That's a very narrow way of looking at it. Okay. Next we'll look into is that the timing difference between cash flow and profit. Okay. The timing difference between cash flow and profit. What about it? Right. So when we look into the timing difference of cash flow and profit, it basically just simplifies the idea that the biggest difference between NPV or the cash view is that we discount cash flow, so early losses are fine. Okay, but in case of profit, what happens is accounting accounts show profit each year. Investors will see this. Okay, so what happens is for NPV purpose, the timing of the cash flow with a project is taken account of through the discounting process. So it is therefore irrelevant if the cash flow in the earlier years are negative, provided overall the present value of the cash flow outweighs the cost. So see, in case of cash flow, what we are seeing is we see on an overall basis. So even in first few years, if the cash flow is less, it does not matter, right? Because when you're calculating the NPV, you consider all the cash flows from the project over the useful life, right? So when we discount cash flows, so even if earlier there are lesser cash flows, right, or there are outflow in the initial cash flow, but the overall NPV is positive, we will still accept the project, right? So NPV only cares about the total value, right? Not what 1 year looks like, right? NPV looks into the total value, like over the next 4 years, 5 years, how much money you're making, present value of everything. And if the project is positive, you will go for it. So in case of NPV, you're looking into the overall. But what happens for profit is that new investments will bring about higher levels of depreciation in the earlier years, which are not yet matched. This will reduce the profits. In case of profits, what happens is investors see this. If there's a new project, there will be more depreciation, there will be more cost now, but revenue will come later, right? So whenever the impact on profits of a new project is that if you do a new investment, it will bring higher level of depreciation. Right? If you bought a new particular machine for a new project, you have established a new machine. What is the new machine doing? It's bringing higher level of depreciation in the earlier years because the value of the machine will be high when it's new. And hence you will see in the early years, you might not get that much revenue because you've just started a certain project. In the early years, you might not get revenue, but you will get a very high depreciation. So what will happen? Your profits and EPS figure both will come down, right? So now what will happen is this reduction that is happening. So what is happening is when you plan a new project, you are not going to consider the entire life of the project. You are just basically, if you're looking from a profit perspective, you just look this year what happened. This year there was a major outflow. Why there was a major outflow? Because you set up the machines, you set up the system, you hired the employees. There's outflow. Revenue will slowly start coming. So for the first few years, you will see it will all be negative. For the first few years, you will see it will all be negative, right? And also the profits will be lower because the depreciation will be lower because machines are brand new. So the depreciation will also be a higher amount because the value of the machine is high right now. The depreciation will also be a big amount. And initial years you will not get that much revenue because you've just started a business. So what will happen is you will see that the reported profits will be low. So this will reduce the reported profits and the EPS figure. All these activities cumulatively will reduce the profits, reduce the EPS, revenue will anyway not be higher in the first few years if you do a new project. So this reduction could impact the share price, it could impact the key ratios, it could impact the loan covenants, right? It could impact the loan covenant. So when that profit goes low, the profit drop can hit the share price. Investors don't know profit is low because of a new project. They will just sell. Investors won't know. They don't know so much finance, right? They will not know that much finance. So they will just be like the profit is falling, it's low, sell it off, sell the share. Right? The key ratios will get worst. Loan covenants might be breached. So NPV basically, so summarizing everything in one sentence is that NPV ignores the timing of losses, but profits don't. So a good NPV project can still hurt the share price ratios and loan agreements in the short term, but in the long term it will make it worthwhile. Okay. So what they're telling over here is that even if your project is positive NPV, that is eventually over 5 years, the total money you will make will be positive. But in the short run, even a positive NPV project can make you losses. In the short run, don't be surprised even if the positive NPV project will make you losses because NPV is profitable. It looks into the entire life of the project. Okay, it looks into the entire life over a 5 year period how things look like. They just don't look like right now. They just think see that over a 5 year how it looks like. So NPV, a positive NPV can still cause negative numbers in the starting year, and that is very normal to have. Right, that is a very normal number to look at as a normal phenomenon to understand that even if a project is negative right now, making losses right now, eventually it will make profit over the 5 year period. It will definitely make profit, right? But right now it will make everything look negative. So we should not be surprised that even if there is a negative positive NPV, but in the first few years it is making a negative cash flow for us. Okay, so that is also the a normal acceptable reality of a positive NPV project. Okay. So just to get a crux of the entire paragraph, because they have just discussed a couple of ideas here. So just to give you a crux of the entire paragraph, if I were to tell you, is that NPV cares about total cash, but financial statements basically care about profit each year. A good project can still hurt the reported results. So that's why when you are looking into a project, don't just look into the fact that it is increasing your shareholder wealth. Also look what is the immediate impact it will happen on the P&L. What is the immediate impact it will happen on the balance sheet. Also consider that. That's the point they are making. That when you look into an NPV is positive and you're like, yes, let's go for it. Positive NPV project. Yay, we'll make money. But that is happening over 5 years. Immediately by today, this year, it will make a lot of losses. It may make a lot of negative cash flow, and that will relate to, and that will result in your P&L looking bad, balance sheet looking bad, ratios looking bad, everything looking bad. So you should consider that bad looking also. That if you do this project first year, everything will go for a toss. So you should be okay with that, and you should keep that reality also considered. Okay, overall it will make profit, no doubt. 5 years it will make a profit, but first year also all your numbers will go for a toss, and you should purely accept the implication that will have from investors. And when investors see that, they might take their money out, right? So you need to consider that also. That's the point I'm making, right? All this information for just one point, that when you looked into an investment appraisal over the 5 years, a project was making money and you were very happy with it, that yes, I'm going to make money over the 5 years. But immediately it's not making money. In the first 2 years it's making losses, and because of that your financial statements are looking horrible. And so you should clearly consider that fact also, that for the first 2 years everything will be horrible and how your investors will react for it. Don't just see NPV positive, go for it. Also see in the first 2 years what it's doing and can you live with that. That's also an important consideration. Okay. Did you get the clarity of this here, Shri? Okay, so that is all about this. I think this is done. This is done. Capital rationing is done. Duration is done. Payback is only left. So again, this is left for detailed understanding, but sure, let's finish our payback also and we are done with this chapter. Do you have some payback questions? We had one payback question. I remember. Yes. Calculate the project's discounted payback period and the Macaulay duration. So let's just finish the payback period part here. And the Macaulay duration for payback, first we will need the discounted cash flows. So all the cash flows first we'll discount it using the extra interest rate of 10% for 1 year, 10% for 2 years, 10% for 3 years. We'll discount all the cash flows first. Okay, first what we'll do, we'll discount all the cash flows. First what we'll do is we'll discount all the cash flows. We'll take 10% discount factor. And what we've done, we have discounted all the cash flows. So these are all the present value. That means these are all the discounted cash flows. Easy. Okay, then we'll take a cumulative. First year 127 only. Second year we needed to recover 127, but we recovered only 33. So how much is yet to recover? 93. Next year how much is yet to recover? 43. After second year how much is yet to recover? 50. But then we earned 57. So 2 years will definitely be the minimum period we need. Plus in the third year we needed 50.4. to recover, but we earned 57.1, more than what we needed. So 2.9. So 2.9 years is what we will need. 2.9 years is our discounted payback period. 2.9 years is our discounted payback period. So within 2.9 years, we will get everything back. So that's how you do a discounted cash flow payback, a discounted payback period, right? Within 2.9 years, we will get everything. Right? So first you took the present values, then you started doing the cumulative present values. Took the negative from the first year, then you need to recover this. You're just seeing how long will it take to recover your initial investment. That is your discounted payback period. Initial investment was 127, as you can see. First year you want 33, so you recovered some part of it. Then 93.4, then you recovered some part of it. Then 50, you recovered some part of it. Then 57, you recovered. By the third year, you already recovered everything. So by 2.9 years, everything came back, and now you're again positive here. That is about this. Okay. You have a discounted payback period here, Sri? So that is all us looking into the first two chapters here and finishing all the TYUs, all the theory about it. That is about this.